Two lawyers, same firm, same salary, $300,000 a year. One retired at 50 with $2.8 million in full financial freedom. The other is still working at 60, stressed, trapped, wondering if he'll ever escape. What was the difference? 5 decisions they made in their 30s and 40s. 5 rules about money that separated freedom from lifelong work. If you're ready to learn the real path to financial freedom, the one that takes 15 to 25 years but actually works, hit that like button, because what I'm about to show you isn't sexy. It's not fast, but it's the only thing that actually gets you out of the rat race. Before we get into this, do me a favor. Drop a comment and tell me where you're watching from. I want to know who's here. City, state, country, just let me know. Here's the truth nobody wants to hear. If you're 35 today and you follow these 5 rules, you can be financially free by 50 to 60. If you're 4 to 5 today, you can be free by 60 to 70. But if you wait, if you keep doing what you're doing, you'll work until you physically can't. Because financial freedom isn't luck. It's math. And the math doesn't care about your excuses. Most people think financial freedom requires a massive windfall, a big promotion, a business exit, an inheritance. Winning the lottery, that's nonsense. You escape the rat race by building income streams that don't require your time. Passive income that compounds while you sleep. Not brilliance, just systematic wealth construction over decades. You don't need to be smart. You just need to not be stupid longer than everyone else. And if you're looking for a shortcut, you'll likely waste years chasing illusions while disciplined people quietly build freedom. I'm going to show you the 5 rules Warren used to build financial freedom. Rules that anyone can follow, but most won't, because they require patience. The first rule is the hardest. Let's start. Juxta Rule 1. Build the income gap first. Most people think financial freedom means having enough money to quit working. That's backward. Financial freedom means having enough passive income to cover your expenses. The size of your portfolio matters less than the gap between what you earn and what you spend. Here's the truth. If you spend $100,000 per year and your portfolio generates $30,000, you're not free. You need $70,000 from your job. You're still trapped. But if you spend $40,000 per year and your portfolio generates $50,000, you're free. Even though the second person has less total income, they have freedom. The first person doesn't. The problem is that most people focus on the wrong number. They ask, how much do I need to retire? They calculate some magic number, 2 million, 3 million, 5 million, and they work toward that number for decades. But they never ask the more important question. How much do I actually need to spend? And that question determines everything. The second problem is lifestyle inflation. As people earn more, they spend more. They think they're building toward freedom, but they're just building a more expensive prison. They need more passive income to cover higher expenses. The gap never closes. They run faster on the treadmill, but never get off. The third problem is that people don't understand the math of passive income. They think $1 million generates $1 million per year. It doesn't. $1 million at 4% withdrawal rate generates $40,000 per year. If you spend $100,000, you need $2.5 million. If you spend $50,000, you need $125 million. Your spending determines your freedom number. Let me tell you about those 2 lawyers in Chicago. This was 2000 to 2020. Both started at the same firm. Both made partner. Both earned $300,000 per year by 2010. Lawyer A lived on $280,000 per year. Big house in the suburbs, $8,000 mortgage. Private schools for 3 kids, $60,000 per year. Country club membership, luxury car leases, expensive family vacations to Europe every summer. He looked successful. He felt successful. His neighbors envied his lifestyle. He saved $20,000 per year in his 401k, about 7% of his income. Good, but not great. By 2020, after 20 years of work, he had $450,000 saved. At 4% withdrawal rate, that generated $18,000 per year in passive income. But he needed $280,000 to maintain his lifestyle. He was nowhere close to freedom. The gap between his passive income and his spending was $262,000. He had to keep working. He had to keep grinding. He couldn't even think about retirement until 65, maybe 70. And even then, he'd have to drastically cut his lifestyle. Lawyer B lived on $80,000 per year. Modest house in a good neighborhood, $2,000 mortgage. His kids went to public schools, no country club. He drove used cars that he kept for 10 years. His vacations were road trips and camping. He looked ordinary. His neighbors probably thought he was less successful than Lawyer A, but he saved $220,000 per year, 73% of his income. Almost 3/4 of everything he earned went straight to savings and investments. By 2020, he had $2.8 million saved. At 4% withdrawal rate, that generated $112,000 per year in passive income. He needed $80,000 to live comfortably. He had a $32,000 annual surplus. His passive income exceeded his expenses by 40%. At age 50, he walked into his managing partner's office and quit. Full financial freedom. He now spends 6 months per year traveling. He does consulting work when he feels like it, not because he has to. He's completely free. Same starting point, same law firm, same career trajectory, same $300,000 annual income, but completely different outcomes. Lawyer A is still working at 60, stressed about markets, worried about retirement, trapped in a job he's burned out from. Lawyer B retired at 50 and has spent the last 10 years doing exactly what he wants. The difference wasn't earnings, it wasn't luck, it wasn't inheritance, it was the gap. Lawyer B built a $220,000 annual gap between his earnings and his spending. He deployed that gap into investments for 20 years. It compounded into freedom. Lawyer A built a $20,000 annual gap. It compounded into stress and continued work. Here's the arithmetic that changes everything. If you earn $100,000 and spend $95,000, you save $5,000 per year. At 8% growth for 20 years with annual contributions, you end up with $247,000. At 4% withdrawal rate, that generates $9,880 per year in passive income. You're nowhere near freedom. You're still completely dependent on your job. But if you earn $100,000 and spend $60,000, you save $40,000 per year. At 8% growth for 20 years with annual contributions, you end up with $1.97 million. At 4% withdrawal rate, that generates $7,800 per year in passive income. You need $60,000 to live. You're free. You've escaped. You never have to work another day if you don't want to. Same $100,000 income. Same 20 years. Different gap. One person is still trapped after 2 decades of work. The other person is financially free and can do whatever they want with their life. Warren always says, don't save what's left after spending, spend what's left after saving. That's the formula. The gap comes first. Savings come first. Investments come first. Everything else, the house, the car, the vacations, the lifestyle, comes after, not before, after. Most people can't do this because cutting spending feels like deprivation. They worked hard. They went to college. They have demanding careers. They feel like they deserve the nice house, the nice car, the nice vacations. And that feeling, that sense of deserving comfort, keeps them trapped forever. Because comfort is expensive. And expensive comfort requires decades of work to maintain. Build the gap first. Live on half your income if you can. 2/3 at minimum. Bank the rest. Deploy it into investments. That gap is your escape velocity from the rat race. It's the fuel that eventually launches you into freedom. But the gap alone isn't enough if you deploy it stupidly into the wrong assets. Well, Rule 2. Buy assets that produce income. Most people who save money buy assets hoping they'll appreciate. They buy stocks that might go up. They buy crypto hoping it doubles or triples. They buy real estate hoping it appreciates. They speculate on growth. They bet on the future. And speculation keeps them in the rat race because growth without income doesn't create freedom. Here's the truth. Financial freedom requires income-producing assets. Dividend stocks that pay you quarterly. Rental properties that generate monthly cash flow. Businesses that produce profits. Bonds that pay interest. Royalties from intellectual property. Assets that pay you cash regularly whether you work or not. Appreciation is nice. It's the cherry on top. But income is freedom. Income is what lets you quit your job. The problem is that income-producing assets are boring. They don't double in 6 months. They don't make exciting stories at parties. A dividend stock paying 3% per year doesn't feel like getting rich. It feels slow. It feels conservative. Meanwhile, crypto going up 500% feels like getting rich. It feels exciting. It feels like winning. So people chase growth and ignore income, and they stay trapped. Because even if growth happens, even if their net worth doubles, it still doesn't replace their salary. They still have to work. The second problem is that people confuse net worth with cash flow. They see their portfolio hit 1 million and think they're rich. They tell their friends they're millionaires. But if that $1 million is sitting in index funds generating $20,000 per year in dividends, and they need $80,000 per year to live, they're not rich. They're not free. They're still completely dependent on their job. Net worth is a vanity metric that looks good on paper. Cash flow is freedom that changes your life. The third problem is that building meaningful income takes time. A $500,000 portfolio at 4% yield generates $20,000 per year. That's not freedom. That barely covers anyone's expenses. So people see that number and give up. They think $20,000 is nothing. Why bother? But they're missing the compounding effect. That $20,000 this year becomes $25,000 in 5 years as dividends grow and you reinvest. Then $35,000 in 10 years. Then $50,000 in 15 years. And suddenly you're covering half your expenses from passive income alone. You're halfway out of the rat race without even realizing it. Let me tell you about a teacher in Texas. She was 35 years old in 2005. She made $55,000 per year teaching middle school math. She knew she would never get rich on a teacher's salary. She understood that. But she wanted freedom. She wanted options. She wanted to eventually work because she chose to, not because she had to. She lived on $40,000 per year. Modest apartment, used car, cooked at home, took cheap vacations. She saved $15,000 annually, about 27% of her income. But here's what made her different. Instead of buying growth stocks or tech funds or whatever was hot, she bought Dividend Aristocrats. These are boring companies that had raised their dividends for 25 or more consecutive years. Procter & Gamble, Johnson & Johnson, Coca-Cola, 3M, McDonald's, companies that make soap and Band-Aids and soft drinks and Big Macs. Nothing exciting, nothing sexy, just boring, predictable, dividend-paying companies. She bought them every single month. A more than $250 per month like clockwork. She reinvested every dividend automatically. She never looked at the daily stock prices. She just kept buying. By 2010, 5 years in, her portfolio was $110,000. It was generating $3,500 per year in dividends. Not much, barely noticeable, but she kept going. By 2015, 10 years in, her portfolio was $280,000. It was generating $10,500 per year in dividends. Now, it was starting to matter. That was 26% of her income being replaced by passive income. By 2020, 15 years in, her portfolio was $520,000. It was generating $22,000 per year in dividends. That was 55% of her teaching income, more than half her salary replaced by dividends from boring companies. By 2024, at age 54, her portfolio had grown to $680,000. It was generating $32,000 per year in dividends. She still needed $40,000 per year to live comfortably. Her dividends covered $32,000 of that. She only needed $8,000 from teaching, about 15% of what she used to need from work. So you know what she did? She dropped to part-time. She now teaches 3 days per week instead of 5. She makes $33,000 part-time. Combined with her $32,000 in dividends, she has $65,000 per year. She only needs $40,000 to live. She has a $25,000 annual surplus that she's continuing to invest. She's functionally free at age 54. She works when she wants. She travels all summer. Her portfolio keeps growing. And she's living proof that you don't need a high income to escape the rat race. You need the right strategy. She never made more than $65,000 per year in her entire career. She never invested in anything exotic or risky. She just bought boring dividend stocks for 20 years and let the income compound. That's it. That's the whole strategy. Now compare that to her colleague who chased growth. Same age, same starting year, same salary, same savings rate of $15,000 per year. But he bought whatever was hot. Tech stocks in the 2000s. Lost half his money in 2008. Bought more tech stocks in the 2010s. Bought Tesla. Bought crypto. Bought meme stocks in 2020 and 2021. His portfolio swung wildly up and down. By 2024, his portfolio was $580,000, only $100,000 less than hers in total value. But here's the critical difference. His portfolio generated only $8,000 per year in dividends because growth stocks don't pay dividends. He still needed $47,000 from his teaching salary after accounting for those dividends. He couldn't afford to go part-time. He was still working full-time at 54. Still trapped, still grinding, same starting point, same savings, similar net worth on paper, but completely different lives. One person bought freedom with boring dividend stocks. The other person bought speculation with growth stocks and stayed trapped. Here's the arithmetic that proves this. $500,000 invested in growth stocks at 0% dividend yield generates $0 per year in passive income. You have net worth. You look rich on paper, but you have no freedom. You have no income. You must keep working until you decide to sell and start spending down principal. That's not freedom. That's just a slow burn towards zero. But $500,000 invested in dividend stocks at 4% yield generates $20,000 per year in passive income. Every year, forever. You don't have to sell anything. You don't have to time the market. You don't have to hope your stocks go up. The income just comes in like clockwork. And if those dividends grow at 5% annually, which dividend aristocrats tend to do, in 10 years, you're generating $32,570 per year. In 20 years, you're generating $53,666 per year. The income compounds while you sit on your ass and do nothing. That's freedom. That's escape velocity from the rat race. Warren built Berkshire Hathaway as an income-generating machine. The insurance companies generate premium income. The operating businesses generate earnings. That cash flow gave him permanent capital to deploy when opportunities came. He didn't need to sell anything to fund new investments. He had streams of cash coming in constantly. That's freedom. That's optionality. That's power. Buy assets that produce income, not speculation, not hope, not prayers that your investment goes up. Income, dividends, rents, business earnings, interest, cash that actually hits your account every single month whether you work or not. That's how you escape the rat race. But income means nothing if you spend it instead of reinvesting it. Stop for a second. How much passive income do you generate right now? Dividends from stocks? Rental income from properties? Business profits? Interest from bonds? Add it all up. If the answer is $0, you're starting from absolute scratch. If it's $10,000 per year, you're about 1/6 of the way to freedom, assuming you need $60,000 to live. If it's $40,000, you're 2/3 of the way there. Whatever your number is, write it down right now. Because that's your baseline. That's where you are today. And in 10 years, if you follow the next 3 rules, that number will triple or quadruple, but only if you follow the rules. Therefore, Rule 3. Reinvest the income until you're free. Most people who build income streams make a fatal mistake that destroys everything they've built. They spend the income. They get $10,000 in dividends and they book a vacation to Hawaii. They get $20,000 in rental income and they upgrade to a nicer car. They treat passive income like bonus money, like found money, like something they can spend guilt-free. And that mindset keeps them trapped in the rat race forever. Here's the truth. Every single dollar of passive income you spend is a dollar that can't compound into more income. If your portfolio generates $20,000 per year in dividends and you spend all $20,000, you stay at $20,000 per year forever. You never grow. You never escape. But if you reinvest that $20,000, next year it becomes $21,600, then $23,300, then $25,200, then $27,200. The income snowballs on itself. It compounds. And that snowball is what eventually creates freedom. The problem is that passive income psychologically feels like free money. You didn't work for it. You didn't trade your time for it. The portfolio just generated it automatically while you slept. So your brain says, this is guilt-free spending money. I can use this to improve my lifestyle. And you do. You take the dividends in cash instead of reinvesting them. You spend the rental profits on lifestyle instead of buying another property. You never let the income compound. And your income never grows beyond that initial amount. The second problem is impatience. People build $20,000 in annual passive income after 10 years of work, and they think, this is nothing. This doesn't even cover half my expenses. I need $80,000 to be free. At this rate, I'll never get there. So they get discouraged. They stop reinvesting. They start spending the $20,000 on lifestyle improvements. They essentially give up on the dream without realizing how close they actually were. Because if they just kept reinvesting for 10 more years, that $20,000 would have grown to $60,000 or more. They were 3/4 of the way to freedom. They quit right before the hockey stick phase of compounding kicked in. The third problem is that spending your passive income resets your timeline to freedom. If you need $80,000 per year to be financially free, and your passive income grows from $20,000 to $30,000 to $40,000 as you reinvest, you're making measurable progress toward that goal. But if you spend the $20,000 every single year, you never get closer to freedom. You stay stuck at $20,000 forever. 20 years later, you're still at $20,000. You've wasted 2 decades. You'll work your entire life because you consumed the seed corn instead of planting it. Let me tell you about an engineer in Seattle. This was 2005. He was 40 years old and made $120,000 per year working for a tech company. He started buying rental properties. He saved up for a down payment and bought a duplex. He lived in one unit and rented out the other. Then he saved more and bought another duplex. Then he bought a fourplex. The properties were all in working-class neighborhoods, nothing fancy, nothing glamorous, just solid rental properties with good tenants. By 2010, 5 years in, he owned 4 properties that were generating $35,000 per year in net rental income after all expenses, after property management fees, after setting aside money for repairs and vacancies. $35,000 in pure cash flow hitting his bank account. Now, he had a critical choice to make. He could spend that $35,000 on lifestyle, nicer cars, better vacations, a bigger house, eating out more. His friends and family were telling him, "You earned this. You worked hard for this. You deserve to enjoy it. Take the European vacation, buy the sports car, live a little." But he ignored all of them. He reinvested every single dollar. He used that $35,000 per year as down payments on more rental properties. He kept his lifestyle exactly the same. Same modest house, same used car, same cheap vacations. Every dollar of passive income went right back into buying more assets. By 2015, 10 years in, he owned 8 rental properties, generating $80,000 per year in net income. He still hadn't increased his lifestyle, still reinvesting everything. By 2020, 15 years in, he owned 12 rental properties, generating $140,000 per year in net income. Now the numbers were impossible to ignore. He needed $70,000 per year to live comfortably. His rental income was covering double his expenses. He had a 100% margin of safety. At age 55, he walked into his boss's office and quit his engineering job. He was completely financially free. Now let's talk about his colleague. Same age, same starting year, same income, same idea to buy rental properties. By 2010, he also owned 4 properties, generating $35,000 per year. But he made a different choice. He spent the money. He upgraded from his starter home to a big house in a nice suburb. He bought new cars every few years. He took expensive family vacations to Europe, Hawaii, the Caribbean. He felt rich. He felt successful. He was finally living the lifestyle he'd always dreamed of. His 40s were great. By 2020, 15 years later, he still owned the same 4 original properties. They were now generating $40,000 per year after some rent increases, but that was it. He'd spent every dollar of passive income for 15 years and never reinvested a penny. He still needed his full $120,000 engineering salary to maintain his lifestyle. He was still trapped at age 55. He'd have to work another 10 years at minimum. Same starting point. Same initial success. Different choice about reinvestment. One person reinvested and escaped to complete freedom in 15 years. The other person spent the income and stayed trapped indefinitely. Here's the arithmetic that explains everything. $20,000 in annual passive income that you spend every year stays at $20,000 forever. In 10 years, you've consumed $200,000 and you still have $20,000 in annual income. In 20 years, you've consumed $400,000 and you still have $20,000 in annual income. You work for 30 more years until you physically can't anymore. But $20,000 in annual passive income that you reinvest at 8% annual growth becomes $90,845 in annual passive income after 20 years. You're completely financially free in 20 years instead of never. The difference is consuming versus compounding. Warren never took dividends from Berkshire Hathaway, not one penny. He never paid himself passive income to spend on a bigger house or a fancier car or expensive vacations. Every single dollar that Berkshire's businesses generated went right back into buying more businesses, more assets, more income streams. The cash flow compounded for 60 straight years without interruption. That's why Berkshire went from a failing $20 textile mill to a $900 billion empire. Pure reinvestment. No consumption of the seed corn, just relentless compounding. Reinvest every dollar of passive income until you're financially free. Not until you feel like spending it. Not until you get bored. Not until your friends pressure you. Until the passive income fully covers your expenses with margin of safety. Then and only then do you start spending it. That's the iron discipline that separates people who escape the rat race from people who stay trapped forever. Most people can't do this because reinvesting income feels like punishment. They see the money sitting there in their account. They know it's theirs. They want to enjoy it now. They worked hard to build these income streams. They feel like they deserve to enjoy the fruits of their labor, and they spend it, and they stay trapped, and they work until they're 70. Reinvest until you're free. But reinvestment strategy fails completely if you keep increasing your expenses along the way. Rule 4. Keep your freedom number fixed. Most people make a catastrophic mistake as they build wealth over the years. They increase their freedom number. They start out in their 30s thinking, I need $50,000 per year to be financially free. Then they get a raise at work. Their lifestyle inflates to match their higher income. Now they think, actually, I need $70,000 per year to be free. They get another raise, more lifestyle inflation. Wait, I really need $100,000 per year to be free. The freedom number keeps moving up like a target on a train track that you're chasing but never catching. And they never escape because the finish line keeps moving away from them. Here's the truth. Financial freedom isn't a dollar number that you hit and then you're done. It's a ratio. It's your passive income divided by your annual expenses. If your passive income exceeds your expenses, you're free. You've won. You escaped. But if your expenses keep rising every time your income grows, the ratio never flips in your favor. The numerator and denominator both go up. You run faster on the treadmill going nowhere. You never get off. You just upgrade to a nicer treadmill. The problem is that people subconsciously tie their self-worth to their level of spending. As they earn more money, they feel entitled to spend more money. They feel like they deserve a bigger house because they're more successful now. They deserve nicer cars because they've proven themselves in their career. They deserve better schools for their kids and fancier vacations and country club memberships. They think these upgrades represent success. They're wrong. These upgrades are chains, heavy, expensive chains that require decades more of work to maintain. The second problem is social comparison and keeping up with peers. People see their neighbors upgrading to a Tesla. They feel pressure to match or exceed that upgrade. Their friends start taking expensive European vacations every year. They feel cheap or inadequate staying home or taking road trips. Their colleagues at work join the country club. They feel left out or lower status if they don't join too. So they upgrade their lifestyle to keep pace with the people around them. But here's what they don't realize. Keeping up with their peers keeps them trapped in the exact same rat race that's trapping their peers. Everyone's imprisoned together in an expensive lifestyle arms race. The third problem is that people severely underestimate how expensive lifestyle inflation actually is in terms of how much extra you need to save. Going from $50,000 per year in spending to $70,000 per year doesn't sound like that much. It's only $20,000 more per year. That seems manageable, but at a 4% safe withdrawal rate, you need $500,000 more saved in your portfolio to generate that extra $20,000 per year forever. Every $20,000 of annual lifestyle inflation requires $500,000 more in savings. That translates to 5 to 10 more years of full-time work, depending on your savings rate. Let me tell you about a couple in North Carolina. This was 2008 to 2024. They were both 35 years old in 2008 with a combined household income of $130,000. They had learned about financial independence and decided to pursue it seriously. They sat down and calculated exactly how much money they needed per year to live a comfortable, happy life. They included housing, food, utilities, health care, modest entertainment, occasional travel. The number they came up with was $60,000 per year. At a 4% safe withdrawal rate, that meant they needed to save $1.5 million to be financially free. They made a pact with each other right then. Our freedom number is $60,000 per year. We will not increase it no matter what happens. No matter how much our incomes grow, no matter what our friends do, no matter what society expects of us, we keep our expenses at $60,000 and save everything else. Over the next 16 years, their incomes grew significantly. They both got promotions, raises, bonuses. By 2024, their combined income had grown to $240,000 per year, almost double where they started. But they kept their promise. They kept living on $60,000 per year. Same house they bought back in 2009. Same used cars they've been driving for years. Same modest lifestyle. Every single raise, every bonus, every dollar of income growth went straight to their investment accounts. Nothing went to lifestyle. In their final years, they were saving $180,000 annually, 75% of their income. By 2024, at age 51, they had accumulated $2.1 million in investments at 4% safe withdrawal rate that generated $84,000 per year in passive income. They only needed $60,000 per year to live. They had a 40% margin of safety, $24,000 per year of surplus. Both of them quit their jobs in the same month. Full financial freedom at age 51. They'd been working for 16 years since making their pact. They could potentially enjoy 30 or 40 years of freedom. Now let's talk about their friends. Same starting age of 35 in 2008. Similar starting income levels. Similar income growth over 16 years. But they made different choices. Every time they got a raise, they upgraded their lifestyle proportionally. Bigger house, nicer cars, private schools, expensive vacations, country club membership, all the trappings of success. By 2024, they were living on $150,000 per year. They looked far more successful than the first couple. Much nicer house, much nicer cars, much nicer everything. But here's the math that mattered. To be financially free at $150,000 per year spending, they needed $375 million saved. They'd been saving, but not nearly as much because of their lifestyle spending. By 2024, they had $1.2 million saved. They were only 1/3 of the way to their freedom number. At their current savings rate, they'd need to work another 19 years until age 70 to hit financial freedom. Maybe longer if they kept inflating their lifestyle. Same starting point, same time frame, similar income growth, but completely opposite outcomes. One couple retired at 51 with freedom and margin of safety. The other couple will work until 70, and that's if everything goes perfectly. The difference came down to one decision made 16 years earlier. The first couple fixed their freedom number at $60,000 in 2008 and never moved it. The second couple moved their freedom number higher every single time they got a raise. The first couple escaped, the second couple stayed trapped. Here's the arithmetic that explains the cost of lifestyle inflation. If your freedom number is $50,000 per year, you need $1.25 million saved. If you save $40,000 per year at 8% average returns, you'll reach financial freedom in 18 years. But if your freedom number inflates up to $80,000 per year because you keep upgrading your lifestyle, you need $2 million saved. With the same $40,000 annual savings, you'll reach freedom in 24 years. The lifestyle upgrades cost you 6 more years of working, 6 more years of your life traded for a nicer car and a bigger house. Warren Buffett still lives in the same house he bought in Omaha in 1958 for $31,500. He's worth over $140 billion. He could live anywhere, buy anything, do anything, but he never inflated his lifestyle to match his wealth. He fixed his personal freedom number decades ago at a relatively modest level. And that's a big part of why he's been free to do exactly what he wants for the past 60 years. No golden handcuffs, no expensive lifestyle requiring him to work. Complete freedom. Fix your freedom number today, right now. Write it down on a piece of paper. $40,000, $60,000, $80,000, whatever you actually need per year to live comfortably, and never increase it, ever. Every raise you get, every windfall, every bonus, every dollar of income growth goes straight to savings and investments, not to lifestyle, not to keeping up with friends, not to impressing neighbors, to freedom. You're not trying to keep up with anyone. You're not trying to impress anyone. You're trying to get free. And freedom requires a fixed target that you refuse to move. Most people can't do this because their ego demands visible success. They want the big house that shows everyone they made it. They want the luxury car that announces their status. They want the expensive vacations they can post on social media. But visible success is expensive. It requires decades of continued work to fund. And expensive success keeps you trapped in the rat race forever. Fix your freedom number and never move it. But even a fixed number means nothing without the final critical discipline. Let me ask you something uncomfortable right now. What's your personal freedom number? How much money do you actually need per year to live the life you want? Not what you currently spend, not what society thinks you should spend, not what your friends spend. What do you actually need? Write down that number. Be honest. $40,000, $60,000, $80,000, $100,000. Now multiply that number by 25. That's how much you need saved to be financially free at a 4% safe withdrawal rate. If your freedom number is $60,000, you need $1.5 million saved. If it's $80,000, you need $2 million saved. How far away are you from that number? That gap represents how many years of focused work you have left if you follow these rules correctly, or how many decades if you don't. Rule 5. Work until income exceeds expenses by 50%. Most people quit too early. They spend 15 or 20 years building toward financial freedom. They finally hit the magic number where their passive income exactly equals their annual expenses. And they quit immediately. They think they won. They think they're free. They celebrate. They give notice at work. They feel liberated. And then 6 months or a year or 2 years later, they run out of money. A market crash happens. A medical emergency happens. A bad sequence of investment returns happens. And they realize they weren't actually safe. They were mathematically free on paper, but not actually secure in reality. Here's the truth that separates temporary freedom from permanent freedom. Financial freedom isn't passive income equal to expenses. That's the bare minimum. That's the starting line, not the finish line. Real financial freedom is passive income exceeding expenses by 50% or more. You need substantial margin of safety built in because life happens. Markets crash. Inflation rises faster than expected. Medical costs spike. Roofs need replacing. Cars break down. Kids need help. Parents need help. If your passive income barely covers your expenses with zero buffer, one significant shock destroys you completely. You're forced back into the rat race. The problem is that people are incredibly impatient after working toward freedom for so long. They spend 15 or 20 years saving and investing and building passive income. They finally hit that moment where the math says they're free. Income equals expenses. And they cannot wait one single more day. They're burned out from their job. They're exhausted. They're desperate to escape. So they quit immediately. They feel liberated for a while, but they're actually vulnerable. They optimized for the exact mathematical outcome with zero buffer. And in real life, exact math fails when reality doesn't cooperate. The second major problem is that most people significantly underestimate their actual expenses. They think they spend $60,000 per year based on rough mental calculations. But when they actually track every dollar for a full year, they discover they actually spend $70,000 or $75,000. They forgot about property taxes. They forgot about insurance premiums. They forgot about car repairs and maintenance. They forgot about medical co-pays and deductibles. They forgot about gifts for family. They forgot about the vacation they take every year. All these small and medium expenses add up to much more than they thought. So when their passive income barely covers their projected expenses, their actual expenses exceed their income. They start burning through their principal. They panic. Within a couple years, they're forced to go back to work. The third critical problem is sequence of returns risk. This is when you retire right before a major market crash, and your portfolio gets hit hard in the early years of retirement. If you retire with passive income exactly equal to your expenses, you have zero buffer to absorb any income reduction. When the market crashes and dividend income gets cut by 30%, your passive income drops below your expenses. You have three bad options: drastically reduce your spending and lifestyle, sell investments at the bottom to cover expenses, and permanently reduce your portfolio, or go back to work. All three options are terrible. But if you have 50% more passive income than you actually need, the crash cuts your income, but you still have enough to live comfortably. You survive the storm that destroys others. Let me tell you about two people who both retired in 2007. Both were 55 years old. Both had spent the previous 20 years building passive income streams specifically to achieve financial freedom. Both felt they were ready to retire. Person A had $1 million in investments generating $40,000 per year in dividend income. Person A needed exactly $40,000 per year to cover all living expenses. The math was perfect. Income exactly equaled expenses. Person A felt completely free and gave notice at work. Retired in early 2007. Finally free after 2 decades of work. Person B had $1.5 million in investments, generating $60,000 per year in dividend income. Person B also needed $40,000 per year to cover living expenses. But Person B had a 50% margin of safety, $20,000 per year of surplus passive income. Person B also felt free and retired in early 2007. Then came 2008 and 2009. the worst financial crisis since the Great Depression. The stock market crashed 50% from peak to trough. Dividend-paying companies across the economy cut their dividends to preserve cash. It was brutal. Person A's passive income dropped from $40,000 per year down to $28,000 per year as companies slashed dividends. But Person A still needed $40,000 per year to live. There was now a $12,000 annual shortfall between income and expenses. Person A panicked, tried to reduce spending, but couldn't cut enough. Started selling stocks at the absolute bottom of the market to cover the shortfall. This destroyed future income potential and burned through principal at the worst possible time. By 2010, Person A had only $600,000 left in the portfolio and was forced to go back to work part-time to supplement the reduced income. Freedom had lasted only 3 years. Person B's passive income also dropped from $60,000 per year down to $42,000 per year, the same 30% dividend cut that hit everyone. But Person B only needed $40,000 per year to live. Even after the crash, there was still a $2,000 annual surplus. Person B cut some discretionary spending like vacations and eating out, but didn't have to touch the principal at all, held all investments through the crash. By 2013, the market had fully recovered. Person B's passive income was back up to $65,000 per year. By 2024, after years of dividend growth and reinvestment, Person B's passive income had grown to $95,000 per year, while expenses had only grown with inflation to $45,000. Person B never worried, never sold anything at the bottom, never went back to work, and lived with complete financial security for 17 years and counting. Same market crash, same starting year, same dividend cuts across the economy, but completely different outcomes. One person's freedom lasted only 3 years before failure. The other person's freedom was permanent and actually got stronger over time. The difference was purely the margin of safety. Person A had 0 buffer. Person B had 50% buffer. That difference meant everything. Here's the arithmetic that proves why margin matters so much. If you need $60,000 per year to live and your passive income is exactly $60,000, you have 0 margin of safety. If your income drops 30% due to a market crash or dividend cuts, you're immediately in crisis mode. You're short $18,000 per year. You're forced to make desperate decisions at the worst possible time. But if you need $60,000 per year to live and your passive income is $90,000, you have 50% margin of safety. Now your income can drop 33% and you still have exactly enough to cover your needs. You can drop 40% and you're still very close. You survive the crash that destroys others. You hold your investments. You don't panic. You don't sell at the bottom. You wait for recovery. And when recovery comes, you're even stronger than before. Warren Buffett never deploys all of Berkshire's capital. He always keeps huge cash reserves, sometimes $40 billion, sometimes $60 billion, sometimes $100 billion just sitting there. People constantly criticize him for this. You're wasting returns. Deploy that cash. But Warren wants massive margin of safety. He wants to be able to survive anything and take advantage of opportunities when everyone else is desperate. When 2008 came and the financial system was collapsing, Warren had $40 billion in cash ready to deploy. While everyone else was panicking and selling, he was buying. He got incredible deals because he had margin. That's what real freedom looks like. Work until your passive income exceeds your annual expenses by 50% or more. Not until it exactly equals your expenses. Not until you're close enough. Until you have substantial margin built in. That extra 1 or 2 or 3 years of work creates a permanent buffer that makes your freedom secure instead of fragile. Most people absolutely cannot do this because those final 1 or 2 years feel unbearable when they're so close to freedom. They can see the finish line right there. They're exhausted. They're burned out. They're desperate to quit. So they quit at exactly the wrong moment, right when they hit the minimum number instead of the safe number. And they regret it within a couple years when the first shock hits and they realize they didn't build enough buffer. Wait for the margin of safety. Work the extra year or two. Build the buffer. That's what makes freedom permanent instead of temporary. That's how you escape the rat race for good and never have to worry about going back. I learned all of this through 60 years of building Berkshire Hathaway. Charlie and I built it from 1965 to today. We never tried to escape from work. We loved what we did. But we built a cash-generating machine that produced far more income than we could possibly spend. The insurance companies generated premiums. The operating businesses generated earnings. We reinvested those earnings into buying more businesses. The cash flow compounded year after year after year. We never touched it for lifestyle. We never increased our personal spending as Berkshire grew. We just let it compound. By the early 1980s, about 15 to 20 years in, Berkshire was generating enough cash flow that neither Charlie nor I actually needed to work anymore from a financial perspective. We were both completely financially free. Our passive income from Berkshire's dividends and earnings far exceeded our modest personal expenses. But we kept working because we genuinely loved what we did. That's real freedom. Not being forced to quit because you're desperate. Not needing to work, but choosing to work anyway because you find it fulfilling. Having the complete option to quit any day and choosing to stay because you want to. The people who truly escape the rat race and achieve real freedom don't run away from work like it's a prison. They build enough passive income that work becomes completely optional. Then they make a choice on their own terms. They work because they want to, not because they have to. Or they don't work at all. Either way, they choose. That choice is freedom. That optionality is freedom. Let me make this as simple as possible. Here are the 5 rules that will get you out of the rat race in 15 to 25 years. 1. Build the income gap first. Live on half your income if possible. 2/3 at minimum. The gap between earnings and spending determines everything. The bigger the gap, the faster you escape. 2. Buy assets that produce income. Dividend stocks, rental properties, businesses, bonds, not speculation on growth, not hoping things go up. Actual income that hits your account whether you work or not. 3. Reinvest every dollar of passive income until you're completely free. Don't spend it. Don't treat it like bonus money. Reinvest it to compound into more income. The snowball effect is what creates freedom. 4. Keep your freedom number fixed forever. Decide how much you need to live. Write it down. Never increase it, no matter how much your income grows. Every raise goes to savings, not lifestyle. 5. Work until your passive income exceeds your expenses by 50% or more. Don't quit at the minimum. Build margin of safety. That buffer is what makes freedom permanent. These aren't complicated rules. A middle school student could understand them, but almost nobody follows them because they take 15 to 25 years of discipline. People want freedom fast. They want it now. They want shortcuts. So they waste decades chasing illusions while disciplined people quietly build real freedom. I'm 94 years old. Charlie and I built Berkshire for 60 years using these exact 5 rules. We built massive income gaps by living modestly despite growing wealth. We bought income-producing assets, insurance companies, and operating businesses that threw off cash. We reinvested every dollar for decades without touching it. We never inflated our lifestyles, and we always maintained massive margin of safety. Those two Chicago lawyers I told you about at the beginning, same firm, same salary. One retired at 50 with $2.8 million. One is still working at 60. The difference was 5 decisions. The Texas teacher never made more than $65,000 in her life, but she's working 3 days a week at 54 because she bought boring dividend stocks for 20 years and reinvested everything. The Seattle engineer, he reinvested his rental income instead of spending it on lifestyle. He quit at 55 completely free, while his colleague who spent the income is still trapped. The North Carolina couple, they fixed their freedom number at $60,000 in 2008 and never moved it, despite doubling their income. They retired at 51 with margin of safety while their friends will work until 70. Don't be the person who works until 70 wishing they'd started at 35. Don't be the person making $200,000 who's still trapped because they spend $195,000. Don't be the person who builds $40,000 in passive income and then spends it all instead of letting it compound to $120,000. Here's what you do today. First, calculate your freedom number. What do you actually need per year to live the life you want? Not what you currently spend, what you actually need. Write it down. $40,000, $60,000, $80,000. Now multiply by 25. That's your target number at 4% withdrawal rate. Second, calculate your current gap. Your income minus your spending. If you make $100,000 and spend $95,000, your gap is only $5,000. That's not enough. You need at least 20% to 30% gap minimum. 50% gap is ideal. If your gap is less than 20%, you're not building freedom. You're building a more expensive prison that requires more work to maintain. Third, calculate your current passive income. Add up every dollar you receive that doesn't require you to work. Dividends from stocks, interest from bonds, rental income from properties, business profits, royalties, everything. If the number is $0, you're starting from absolute scratch. If it's $10,000, you're maybe 1/6 of the way there. If it's $40,000, you're more than halfway. Whatever your number is, write it down. That's your baseline. Fourth, write down your freedom number on a card and tape it to your bathroom mirror where you'll see it every single morning. Never increase that number, ever. No matter how much your income grows, no matter what your friends do, no matter what society expects, that number is fixed. Every raise, every bonus, every windfall goes to investments, not lifestyle. Fifth, commit right now to reinvesting every dollar of passive income until you're completely free. Don't spend it. Don't treat it like bonus money. Don't let your brain trick you into thinking it's guilt-free spending money. It's freedom fuel. It compounds into more income. And that compounding is what eventually sets you free. Freedom isn't complicated. It's just math over time. Gap, income assets, reinvestment, fixed spending, margin of safety. Follow those 5 rules for 15 to 25 years, and you're free. Ignore them and work until you die. It's that simple. The formula is right here in front of you. Most people will watch this, nod along, feel motivated for a day, and then do nothing. They'll go right back to spending 95% of their income. They'll keep chasing growth stocks that don't pay dividends. They'll spend their passive income on lifestyle. They'll inflate their freedom number every time they get a raise. And they'll work until they're 70 or 75, wondering why they never escaped. A small percentage of people will will actually do this. They'll cut their spending dramatically. They'll build the gap. They'll buy boring income-producing assets. They'll reinvest everything for decades. They'll fix their freedom number and never move it. And in 15 to 25 years, they'll be completely free while everyone else is still trapped. Which group will you be in? That's your choice to make. Now, if you want more brutal honesty about building financial freedom, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. I don't promise easy. I don't promise fast. I promise truth. And drop a comment right now. What's your current passive income? $0? $5,000? $20,000? $50,000? Be completely honest, because you can't fix what you won't measure, and you can't improve what you won't acknowledge.